It's interesting to note that the IMF has today released its estimates for the US economy. And it thinks the US economy is going to grow by 7% this year. And it's released its estimate for the Australian economy, and it thinks the Australian economy will grow by 5.3% this year. Why I find that particularly interesting is that on Monday I released a piece on employment and Australian growth. And in that piece I said that the Federal Reserve thought that the US would grow by 7% this year, and that I said that I thought that the Australian economy will grow by 5.3% this year. So I congratulate the IMF in their excellent judgment and forecasting. The piece I want to talk about today is how rising commodity prices support real wages, and it follows directly from the webinar that I did with Governor of the Reserve Bank, Philip Lowe. There is a national panel of esteemed economists that is associated with the Economic Society of Australia, and I like to think for reasons of mistaken identity I'm included in that panel. But the panel gets a regular survey a number of times a year, and that's made available to the media. So the current survey is being done this week, and it's released to the media next week. And since what Governor Philip Lowe was talking about in the webinar we did was, and what the piece I wrote about it, was the major thing that he was talking about was growing real wages. So the panel's question was, what is the best way to grow real wages? And the proposition put to the panel was that higher wages growth is now a top priority for the RBA in an effort to sustain strong economic growth. And the members of the panel were asked to decide on 3 policies of a list of 10, and these policies were agreed to emphasise the issues of immigration, business investment, labour market flexibility. I note that I think it was a particularly important panel and a particularly important discussion, because a lot of the things that are discussed in this survey are things which I think would be are incredibly likely to be major issues that are taken forward to the next federal election. And in particular, I think a lot of the discussion by economists of things like putting up real wages by making trade unions stronger, or directing wage-fixing organisations to give higher wages results, I think they're very likely to be part of a platform of one side of politics. So we're asked to, as well as provide these a selection of these policies, we were asked to provide comments. My comment was that the proposition that the RBA wanted to generate higher wages in an effort to sustain higher economic growth was not, in fact, what the RBA said. The RBA, in the person of Governor Philip Lowe, had said that he wanted to generate higher wages in order to support inflation. He said that only if he ran wages 1% higher than inflation, would he be able to put upward pressure on inflation sufficient enough to hit his inflation target. And he further said that he wanted to reduce unemployment to a sufficiently low level, somewhere below 4.5%, where increases in real wages could be maintained at a level of at least 3% in order to achieve average inflation rate of his target of about 2%, and that meant that he would be pushing up real wages. When I noted that when we look at the data of wages growth for this century, what we saw was that real wages tended to go up when commodity prices are going up, and when commodity prices were putting up the terms of trade, and that we're now experiencing a significant rise in commodity prices and a significant increase in the terms of trade during this our recovery. All we needed to do is allow the good people of the RBA to do their work, and we would see real wages rise over the coming period. None of the policies that the other policies discussed were actually necessary while commodity prices were rising and pushing up the terms of trade. However, I said that when commodity prices ceased to rise, it would be a good policy to reduce the Australian corporate tax rate from the current level of 30% to the average OECD level of 25%, and that would encourage business investment and stop real wages growth from stalling. We can test my proposition that rising commodity prices increase the demand for labour in Australia and thereby increase real wages by constructing a simple model based on Australian GDP and the RBA index of commodities. When we do this, we find that employment primarily goes up in line with Australian GDP, but we find it goes up even more rapidly as commodity prices are rising. The reason it does so is closer to an accounting identity rather than economic explanation. The way GDP is calculated is by calculating a real volume of production by dividing a nominal value of production by the price of that production. This means that it calculates the volume of Australian commodities produced by dividing the dollar value of commodity exports by their price. Because employees are paid in Australian dollars, this underestimates the number of new employees that can be paid by money earned when commodity prices are going up. Another way of putting this is that employment is more of a function of nominal GDP than real GDP. That means we do not need additional policies to increase employment and allow for real wages to rise when rising in nominal commodity prices are generating additional rises in nominal GDP. This means as long as we have a commodity boom continuing in Australia, we expect the RBA to be successful in their quest to push up Australian real wages. They will be able to hit their inflation target after years of failing to do so when commodity prices were soft. Like I say, I think this panel questions are going to get a lot of possibility because you're going to have a lot of things about intervening in the labour market, which esteemed economists will provide detailed discussions of and could support various policies going forward to the next federal election.